$374,000. That's what you walk away with after 9 years in the wrong ETF. $502,000, that's what the right one gives you. Same $100,000, same 9-year stretch, same market conditions. $128,000 difference just from the ticker. And that gap, that's before the next decade even starts. This is FinOptics. We don't do opinions here, we do math. Today, we're settling the ETF by age debate once and for all. 6 ETFs, real backtests, real returns, real down years, decade by decade. We're covering SCHG, QQQ, VOO, VTI, VGIG, SCHD, JEPI, JEPQ, and yes, STRC. What actually belongs in your portfolio and what doesn't? We're running 3 real scenarios: a late starter, a small investor, someone who wants out early. And in Section 5, we're answering the question every other video in this space quietly skips. What do you actually do with your old ETF when the decade turns? Sell it? Hold it? What does it cost you either way? Nobody answers that one honestly. We will. Let's get into it. Section 1. Why age-based frameworks? Before we get into the ETFs, let me ask you something nobody in this space ever asks. Why would the same ETF make sense for a 23-year-old and a 67-year-old? It wouldn't, obviously. And yet, most people pick one fund, set it, and forget it for 40 years straight, and then wonder why something feels off when they're approaching retirement. Here's a way to think about it. Imagine you're on a road trip. At mile 20, you drive fast, you take risks, you miss an exit. Fine, you turn around, you've got time. But at mile 980 of a 1,000-mile drive, you slow down. You're checking the GPS every 10 minutes. A wrong turn at that point doesn't cost you 20 minutes. It could cost you the whole trip. Your portfolio works the same way. At 25, a 30% market crash is uncomfortable. You watch your balance drop, it stings, but you have decades for it to come back. At 68, that same 30% crash doesn't just sting, it could push your retirement back 3 years. Same percentage, completely different consequences. And there's another thing that happens slowly, quietly over time, something called portfolio drift. A growth-heavy portfolio gradually becomes more and more concentrated in tech, more volatile, more misaligned with what you actually need your money to do. Most people don't notice this happening. They find out at the worst possible moment, when markets drop and they realize they were holding the wrong thing for where they are in life. Now, the video we're responding to today had solid ETF picks, I'll give it that. But here's what it didn't give you: actual backtest numbers, a real answer to what happens when you switch ETFs between decades, a plan for late starters, a plan for small investors, and an honest look at products like STRC, DGRO, and JEPQ. We're covering all of it today. And the single most important question in this whole framework, we're saving for Section 5, because that's the one that actually affects the money you've already built. All right, decade by decade, real numbers, real backtests. One honest caveat per ETF, because every single one of these has a catch, and I'm not going to pretend otherwise. Let's start with your 20s. SCHG, Schwab US Large Cap Growth ETF. This is your growth engine. Pure, unapologetic, long runway growth. Think of SCHG like a Formula One car. It's built for one thing: speed. It accelerates faster than almost anything else on the road, but every bump feels brutal, and if you panic at the wrong moment and swerve, you crash. At 24 with 40 years ahead of you, that's fine. You have time to recover. The speed is literally the point. Here are the numbers. $100,000 put into SCHG in January 2017. By May 2026, that's $502,169. Expense ratio of 0.04%. In calendar year 2022, SCHG fell 31.8%, and its peak to trough drop that year was even steeper, closer to 35%. One caveat I want to be loud about: 2017 to 2026 was an unusually strong stretch for growth stocks. QE, the post-COVID melt-up, and the AI boom all stocked up. That works out to roughly 19% a year, and I need you to hear this clearly. That is not a promise. The long-run number for US stocks is closer to 10%. Use these figures to compare the funds against each other, not as a forecast of what your money will do. Now, I already know what some of you are thinking. QQQ made more money over the same period, $600,870 versus $502,169. QQQ won by nearly $100,000. So why not just pick QQQ? Here's the thing. QQQ charges 0.18% per year. SCHG charges 0.04%. That's 4.5 times more expensive today. And for most of the last decade, QQQ actually charged 0.20%. So the drag has been even bigger, compounding against you silently. On a $500,000 portfolio, that's roughly $700 a year in extra fees. Doesn't sound like much. Multiply it by 20 years on a growing portfolio and it stops being a rounding error. SCHG holds roughly 196 stocks to QQQ's 100, but be honest about what that buys you. Both are top-heavy in mega-cap tech. SCHG's top 10 are actually 59% of the fund. The extra names are a long tail, not real downside protection. QQQ is the more aggressive bet, and we'll come back to it in the aggressive alternative section. But for the core 20s pick, SCHG gives you explosive growth at the lowest possible cost. One honest caveat. In 2022, SCHG fell 31.8%. If you had $100,000, you watched it become roughly $68,000 in 1 year. That is genuinely painful. The only way to handle it is to stop checking your portfolio every day. And remember that the Formula One car is built for the long race, not the short one. Into your 30s, the ETF here is VOO, Vanguard S&P 500. This is your stability anchor. Still heavy on growth, but now instead of betting on the fastest cars, you're buying the whole city. VOO is like owning a tiny piece of every major building in America. One building might have a bad year, one neighborhood might decline, but the city itself keeps expanding. New skyscrapers go up, new industries emerge. You own all of it for basically nothing in fees. $100,000 in VOO in January 2017 to May 2026. That's $374,194. Expense ratio of 0.03%. In 2022, VOO fell 18.19% for the full year. The most common question here, VOO or SPY? Honest answer, they track the same index. The returns are nearly identical. The difference is fees. SPY charges 0.09%. VOO charges 0.03%, 3 times cheaper. Over 30 years on a large portfolio, that gap alone can cost you tens of thousands of dollars. Unless you're actively trading options and need SPY's liquidity, which most long-term investors don't, VOO wins on cost. Full stop. One honest caveat, VOO's top 10 holdings make up over 38% of the entire fund. Apple, Microsoft, Nvidia, Amazon, a handful of companies are driving a huge chunk of your returns. It's diversified across 500 companies on paper. In practice, it's more concentrated than it feels. Your 40s. VTI, Vanguard Total Stock Market. If VOO is owning every major building in a city, VTI is owning the city, every suburb, every strip mall, every small business, every startup operating out of a garage. Some of those will fail, but statistically, enough of them turn into the next big thing that having them in your portfolio matters. $100,000 in VTI, January 2017 to May 2026. That's $355,943. Expense ratio of 0.03%. 3,458 stocks. Here's where it gets interesting though. VTI actually returned less than VOO over this period, $355,943 versus $374,194. VOO won by about $18,000. So why recommend VTI for your 40s at all? Because your 40s are when your portfolio size starts to matter more than your return percentage. You're building a foundation that needs to outlast decades of retirement. VTI's 3,458 stocks give you true diversification, including small and mid-cap companies that tend to outperform during certain economic cycles. The VOO-VTI return gap narrows and sometimes reverses depending on the decade you measure. In the 2000s, when small caps crushed large caps, VTI would have won this comparison easily. One honest caveat. Small and mid-cap stocks, VTI's advantage over VOO, underperformed during this specific period of large-cap tech dominance. Broader doesn't always mean better in every 10-year window. It means better over very long timeframes and more resilient across different economic cycles. Your 50s. This is where the strategy starts shifting meaningfully. The ETF is VIG, Vanguard Dividend Appreciation, quality over quantity. Companies that have proven they can grow their dividend year after year through recessions, through pandemics, through market crashes. Think of VIG like investing in landlords, specifically the ones who have raised rent every single year for at least 10 consecutive years. Not the flashiest buildings, not the hippest neighborhoods, but they never skip a payment, and that consistency becomes incredibly valuable the closer you get to needing the income. $100,000 in VIG, January 2017 to May 2026. That's $319,236. Expense ratio of 0.04%. And now look at this. In 2022, VIG fell just 9.81% for the year, while the S&P 500 fell 18.19% that year. VIG cut that loss nearly in half. That's what dividend growth quality actually does in a bad market. It acts as a natural shock absorber. Quick note on DGRO. iShares Core Dividend Growth ETF, higher yield than VIG at 2.01% versus VIG's 0.04%. If income is your priority in your 50s, DGRO is worth a look. If you want the lowest cost and the slightly more conservative quality screen, VIG wins. Both are excellent. Neither is a mistake. One honest caveat, VIG's yield of 1.56% is lower than SCHD's 3.22%. You're not collecting real income yet, you're building quality. The payoff comes in your 60s when you shift into SCHD and that income stream finally kicks in. Your 60s. This is the decade the income finally pays you back. The ETF is SCHD, Schwab U.S. Dividend Equity. This is your income machine. SCHD is like a portfolio of rental properties, specifically the reliable ones, not the Airbnb gambles, not the fixer-uppers, the boring, well-maintained properties in stable neighborhoods that pay you like clockwork every quarter without drama. You don't get rich overnight, but you also don't lose sleep at night. $100,000 in SCHD. January 2017 to May 2026. That's $301,730. Expense ratio of 0.06%. Current dividend yield of 3.22%. Now, let me show you what that 3.22% actually means in real money. $1 million in SCHD at today's yield, that's $32,200 per year, paid out every quarter, roughly $8,050 a check, just from dividends before you sell a single share. And then there's 2022. SCHD fell 3.23%, while the entire S&P 500 fell 18.19%. That's not a typo. In one of the worst market years of the last 2 decades, SCHD barely moved. One honest caveat. SCHD's total return of $301,730 is the lowest of all 6 ETFs on this list. You are giving up growth for income and stability. At 60, that's the right trade-off. At 25, it would be the wrong one. Context is everything. And finally, your 70s. JEPI, JP Morgan Equity Premium Income. Maximum income, minimum drama. JEPI uses a strategy called covered calls. Plain English version, imagine you own a house. JEPI rents that house to other investors for a fee every single month. Your stocks still grow, but here's the catch. By renting it out, you cap your maximum profit. That's the trade. You get steady income, but you give up the home runs in a roaring bull market. $100,000 in JEPI, measured from its 2020 launch since it didn't exist in 2017, grew to $185,865. Just remember that's a 6-year window, so don't stock it directly against the 9-year figures for the others. Expense ratio of 0.35%. As of recording, the 30-day SEC yield is 9.78%, and in its worst calendar year, 2022, it fell just 3.52%. At that 9.78% yield, $100,000 generates roughly $9,780 per year, $815 per month. Now let's use a more realistic number, $432,000, well above the typical American's retirement balance. The Federal Reserve's 2022 survey put the median retirement account among households that have one around $87,000. At JEPI's current yield, that's $42,249 per year, $3,520 per month. Combined with Social Security, for many retirees, that's a livable income. One honest caveat, and this one matters. JEPI's income is classified as ordinary income by the IRS, not qualified dividends. That means it's taxed at your regular income tax rate, not the lower 15 or 20% capital gains rate. Before holding JEPI in a taxable account, talk to a tax professional. Inside a Roth IRA or traditional IRA, this issue disappears entirely. Also worth knowing, JEPI's yield varies month to month depending on options market conditions. That 9.78% is today's figure, not a fixed rate. During strong bull markets, it tends to compress. During volatile periods, it tends to rise. Section 3. Surprising findings. Okay, before we get into the scenarios, I want to share 3 things that genuinely surprised me when I ran these numbers, because a few of the assumptions I went in with turned out to be wrong, and if I had those assumptions, I'm guessing some of you do too. Finding 1. SCHG versus QQQ. The conventional wisdom in this space is pretty simple. QQQ is the gold standard for growth. Just buy QQQ. Everyone says it. Here's what the data actually shows. QQQ returned $600,870. SCHG returned $502,169. Same $100,000. Same roughly 9-year period. QQQ won, and it wasn't close. Nearly $100,000 more. So why isn't QQQ the primary pick for your 20s? Because nobody talks about what that outperformance actually costs you. QQQ charges 0.18% per year. SCHG charges 0.04%. On a $500,000 portfolio, that's roughly $700 a year in fees every year, quietly compounding against you. Over 20 years on a growing portfolio, that number stops being a footnote. QQQ's outperformance is real, I'm not dismissing it, but so is the cost. For a pure, long-term buy-and-hold investor who's never touching this money for 20-plus years, the fee math matters more than the recent return gap. That gap can close. The fees never stop. Finding 2. VTI versus VOO. Is broader actually better? This one I really expected to go the other way. The logic seems obvious. More diversification is always better, right? VTI holds 3,458 stocks. VOO holds 500. So VTI must be safer and probably better over time. What the data says, VOO returned $374,194. VTI returned $355,943. Same period, VOO won by $18,251. Here's the nuance though. Small and mid-cap stocks, the extra sauce VTI has over VOO, got absolutely steamrolled during this specific period of large-cap tech dominance. Nvidia, Apple, Microsoft, these companies carried the S&P 500 in a way that smaller companies simply couldn't match. But go back to the 2000s when large-cap tech was in a decade-long hangover after the dot-com crash and small caps crushed large caps. VTI would have won that comparison by a mile. Neither is permanently better. VOO is more powerful right now. VTI is broader over the very long run. Which one you lean toward depends on your view of the next decade, and honestly, holding both is not a crazy answer. Finding 3. SCHD in 2022. Let's actually verify this claim. You've heard this one before. Dividend funds protect you in downturns. Every dividend ETF video says it. But is that actually true, or is it just marketing? 2022, one of the worst market years since 2008. The S&P 500 fell 18.19%. SCHD fell 3.23%. VIG fell 9.8%. JEPI fell 3.52%. The protection claim is real, and it wasn't just SCHD. The entire income-oriented half of this framework significantly cushioned the blow. If you were 65 in 2022 and had already shifted into SCHD 3 years earlier, you watched your neighbors panic while your portfolio barely flinched. Now here's the part I want you to actually sit with. People obsess over return percentages. They optimize for the extra 2%, the extra 3%, but not losing 18% in a single year when you're 65, when that money is supposed to carry you through retirement, that might be worth more than any return advantage you could have chased in the years before. Sometimes the best financial move isn't the one that makes you the most money, it's the one that stops you from losing it at the worst possible moment. Section 5 is coming up next, and I'd argue it's more important than anything we've covered so far. The transition question. What do you actually do with your old ETF when the decade turns? Stay with me. Section 4. Aggressive alternatives. Before we get to the transition question, I want to talk to a specific type of person watching this. Some of you are not here to protect wealth. You're here to build it as fast as possible. The core framework assumes a certain level of risk tolerance, and yours is higher than that. You're not losing sleep over a 32% down year. You want to know where QQQ and JEPQ actually fit. Here's your honest answer. For your 20s, QQQ as the aggressive alternative to SCHG. We already covered the numbers. QQQ returned $600,870 versus SCHG's $502,169 on the same $100,000 over about 9 years. QQQ won significantly. That's not up for debate. If you can genuinely stomach the 0.18% expense ratio, have zero plans to touch this money for 20 plus years, and are actually okay, not just telling yourself you're okay, but actually okay watching your portfolio fall 32% in a bad year, QQQ is a legitimate upgrade for the aggressive investor. I want to be careful with how I say this though, because every person thinks they can handle volatility until they're actually living through it. March 2020, October 2022, those weren't just numbers on a screen. People sold. Good investors with good funds sold because the feeling of watching your balance drop every single day is something your brain is not naturally wired to handle. So before you pick QQQ over SCHG, be honest with yourself about which investor you actually are, not which one you want to be. SCHG is the Formula One car. QQQ is the rocket ship. More upside, less stability, burns more expensive fuel. Fine at 22, a completely different conversation at 52. For your 60s and 70s, JEPQ as an income booster alongside SCHD and JEPI. JEPQ is JP Morgan's NASDAQ-focused version of JEPI. Same covered call structure, but instead of broad equity exposure, it's built on the NASDAQ 100. Tech-heavy, higher octane, higher yield. Current 30-day SEC yield about 12.70% as of May 2026. That extra income sounds incredible, and on paper it is, but JEPQ is more volatile, more concentrated in tech, and that higher yield is a direct reflection of higher risk in the underlying assets. You're not getting 12.70% for free. You're getting it because the market is pricing in more uncertainty. Who this actually makes sense for? Someone in their 60s or 70s who already has a stable SCHD core and wants to allocate maybe 10 to 20% into a higher yield position, not as a replacement, but as a complement, a kicker on top of a foundation that's already solid. Same ordinary income tax treatment as JEPI. Same advice. Ideally hold this in a tax-advantaged account. The tax drag in a taxable account will eat into that yield more than most people realize. Who this does not make sense for, and I want to be direct here, anyone who needs their income to be predictable month to month. JEPQ's yield swings more than JEPI's because the NASDAQ swings more than the broader market. If you're budgeting around your dividend income in retirement, that variability is a real problem. In that case, JEPI's slightly lower but more stable yield is the better choice. The honest one-line summary, JEPQ is not a better version of JEPI. It's a different version with more upside and more variance. Know which one you actually need before you buy it. Section 5, the transition question. Okay, this is the one. I've read through hundreds of comments on ETF videos over the years, and this question comes up every single time, and almost nobody answers it directly. They dance around it, they say it depends, they tell you to consult a financial advisor and move on. I'm going to actually answer it. You're 30 years old. You've spent your entire 20s building an SCHG position. Maybe it's worth $50,000 now. Maybe it's worth $80,000. And someone, maybe this video, maybe another one, tells you it's time to shift into VOO. So what do you actually do? Do you sell everything? Do you owe taxes? Do you just hold it forever and hope for the best? Do you gradually shift? And if you gradually shift, how do you do that without making it worse? 3 real options, real numbers. Let's go. Option 1, hold and redirect, the zero tax event strategy. Stop adding new money to SCHG. Redirect every future contribution into VOO. That's it. You're done. Your SCHG keeps growing in the background. You don't sell a single share. You don't trigger a single dollar of capital gains tax. You just start building the next layer on top of what you already have. Think of it like this. You've been driving a Honda Civic since your 20s, and it's been great. You're not getting rid of it. You're just parking it in the garage and doing your daily commute in the new SUV. The Civic keeps sitting there, keeps appreciating. No crash, no loss, no drama. Real example. You're 30, you have $50,000 in SCHG. You stop adding to it and redirect $500 a month into VOO going forward. By the time you're 40, your SCHG has kept growing quietly in the background, and your VOO has built a substantial new position on top of it. You now hold both, which is actually not a bad outcome. Who this works best for? Anyone sitting in a taxable brokerage account with significant gains in SCHG. Zero tax, zero friction, maximum simplicity. If you're not sure which option to pick, start here. Option 2, gradual rebalance. Spread the tax hit over time. Over 2 to 3 years, shift 20 to 30% per year from SCHG into VOO. You sell in stages, spreading your capital gains across multiple tax years instead of taking the full hit at once. Let me show you what the tax math actually looks like, because this is where people get scared without needing to be. Say you sell $10,000 worth of SCHG. $7,000 of that is profit. That's your gain. At the long-term capital gains rate of 15%, which applies to most middle-income earners, you owe $1,050 in taxes on that transaction. $1,050 is real money. I'm not going to pretend it isn't, but spread across 3 years, it's $350 a year. And it's not a reason to stay in the wrong ETF for your life stage just because selling feels uncomfortable. One thing I want to be clear about here, the 15% rate is not universal. Your actual tax rate depends on your total income, your filing status, and the state you live in. This is one of those situations where talking to a tax professional for your specific numbers is genuinely worth it, not just a disclaimer I'm throwing in. Who this works best for? Investors with large SCHG positions who want to fully rebalance but need to manage the tax hit responsibly. You want to get there, you just want to get there without taking an unnecessary punch in 1 year. Option 3, the tax-advantaged free pass. If your ETFs are inside a Roth IRA or a traditional IRA, this entire conversation gets a lot simpler. Inside a Roth IRA, you can sell SCHG and buy VOO with zero immediate tax consequences. Zero. The IRS doesn't see a single dollar of that transaction. Sell SCHG, buy VOO, done. Move on with your life. Inside a traditional IRA, same thing. No taxes on the rebalance itself. You'll pay taxes eventually when you withdraw, but the act of switching ETFs inside the account is a non-event. This changes everything for people who are investing through retirement accounts. If your SCHG is in a Roth IRA, transitioning decades isn't a dilemma. It's a 5-minute task. Click sell, click buy, go outside and touch some grass. Who this works best for? Anyone whose ETF holdings are inside a tax-advantaged account. This should be your default transition strategy if it's available to you. Build your ETF strategy inside these accounts first and save the taxable brokerage for later. Here's the simple breakdown of which option fits which situation. ETFs inside a Roth or traditional IRA, option 3. Zero tax, zero friction, no reason to overthink it. Taxable account, modest gains, option 1. Hold and redirect, no tax event, no stress. Taxable account large gains, option 2. Spread the hit over 2 to 3 years. Very large taxable position, option 1 combined with professional advice. At that level, the complexity is real and the stakes are high enough that a tax professional pays for themselves. Here's the thing I actually want you to walk away from this section. The transition question terrifies people into doing nothing. They stay in SCHG at 45 because selling feels complicated and taxing feels painful, and so they just don't. They tell themselves they'll figure it out later. Later becomes never. Don't let the tax tail wag the investment dog. A $10,150 tax bill is not a reason to hold the wrong ETF for 5 extra years. The cost of inaction, staying misaligned with your life stage because switching feels uncomfortable, is almost always higher than the cost of just making the move. The transition is not the hard part. The hard part is admitting that what worked for you at 25 might not be what you need at 35, and then actually doing something about it.
All right, this is the section I get the most requests for because most ETF content is built around one type of investor. Young, already investing, consistent income, no major complications. Most people watching this are not that person. So let's talk about 3 real situations. First, meet Amara. She's 46 and she's just getting started. Amara spent her 30s paying off student loans, raising 2 kids, keeping the lights on. Investing wasn't an option, it was a luxury she couldn't afford. She's 46 now, she just opened a Roth IRA, and she can put in $500 a month. She wants to retire at 65. That's 19 years. I want to say something directly to anyone who relates to Amara, because the instinct when you see that number is to feel like it's too late, like the window closed while you were busy surviving. It didn't. Here's what 19 years of $500 a month actually produces. SCHG, $827,849. VOO, $598,320. The difference between those two choices, $229,529, just from the ticker. Now, which should Amara actually pick? That depends on one thing. What happens inside her head when the market drops? Here's what that really looks like. In 2022, SCHG fell about 32%, while the S&P 500 VOO fell about 18%. Same downturn, completely different ride. So the real question isn't just can Amara stay calm, it's which drop can she actually live with. If she can hold through SCHG's steeper 30% plus down years without flinching, the extra growth is hers to keep. But if a drop that size would make her panic and stop contributing, VOO isn't a downgrade, it's the shallower ride that keeps her in her seat. And staying invested always beats picking the better fund and bailing at the bottom. $598,320 is not a consolation prize. Combined with Social Security, that is a real retirement. The biggest mistake Amara could make right now has nothing to do with which ETF she picks. It's letting the feeling of being behind convince her to do nothing, because doing nothing for the next 5 years while she thinks about it, that's the decision that actually costs her. She is not too late. The math is clear on that. Second, meet Jake. He's 19, works part-time, and has $300 a month. Jake left a comment that I've seen some version of 100 times. Is it even worth investing $300 a month? Does that actually do anything? Jake, sit down. I need you to actually look at this. $300 a month, $3,600 a year, from age 19 to age 44. That's 25 years. I ran a Monte Carlo on this. Thousands of possible market paths, not one cherry-picked line. The middle outcome for Jake lands around $1.14 million. But here's the honest part the calculators bury. That's the median, so half the paths finish below it. A realistic middle band runs from roughly $438,000 on the low end to $2.7 million on the high end. Treat $1.14 million as a sensible midpoint, not a promise. And remember, the model only knows the market we've already lived through, which has been unusually kind to growth. I want you to pause on that number for a second, because $300 a month feels like nothing. It's a car payment, it's a phone bill, it's a few dinners out. And yet, 25 years of that untouched in a simple index ETF could produce over $1 million. This is the snowball. At 19, your snowball is the size of a softball. You can barely feel it in your hands, but you're standing at the top of a long hill. By 30, it's a basketball. By 40, it's a boulder. By retirement, hard to stop. The only thing that can stop it is you. stopping contributions, pulling money out early, switching strategies every time markets get uncomfortable. Don't stop the snowball, Jake. That's the whole game. Is $300 a month worth it? I think that question just answered itself. Third, meet Daniel. He's 45, just got laid off, and has $650,000 saved up, which is genuinely impressive, and he's considering retiring early to Southeast Asia, specifically Vietnam, and someone online told him to just put everything into SCHD and live off the dividends. Let's actually run that math before we decide if it's good advice. $650,000 in SCHD at today's yield of 3.22%, that's $20,930 a year, $1,744 a month. A comfortable expat life in Vietnam runs somewhere between $800 and $1,300 a month. Numbeo pegs bare single-person costs lower, around $700 with rent, so $800 to $1,300 gives you real breathing room. So on paper, $1,744 a month covers it. The math technically works. But here's where I'd push back hard. Daniel is 45. He might live another 45 years, and there's a risk that most early retirement content completely glosses over. It's called sequence of returns risk. Here's what it means in plain English. If markets drop 20% in your first 5 years of retirement and you're drawing income from that portfolio every single month, you're selling shares at depressed prices to fund your life. Your portfolio never fully recovers, not because the market didn't come back, but because you kept withdrawing while it was down. The damage compounds in reverse. This is the silent killer of early retirements, and going 100% into SCHD at 45 does not protect you from this, because even SCHD is not immune to a sustained downturn. Here's a more balanced approach. 50% in SCHD, $325,000 at 3.22% yield, that's $10,465 a year. 50% in VIG, $325,000 at 1.56% yield, that's $5,070 a year. Total, $15,535 a year, $1,294 a month. Less income today, but VIG keeps growing. It keeps appreciating. It gives Daniel's portfolio something to stand on in year 15, year 25, year 35 of retirement, when the money needs to still be there. And if Daniel wants to boost income on top of that, a 10 to 20% allocation to JEPQ as a yield kicker on the side is a reasonable move, not as the foundation, as the supplement. The honest answer, Daniel can retire to Vietnam. The math works, but 100% SCHD at 45 is not the move. Keep some growth in the portfolio. Make sure the money can outlast you, because at 45, that's a long time.
Section 7. Product Deep Dives. A few products kept coming up in the comments that the core framework doesn't cover, so let's address them directly. One by one, no fluff. First, STRC. And I want to clear something up immediately. STRC is not an ETF. I keep seeing it compared to dividend ETFs in comments, and it's an important distinction because the risk profile is completely different. STRC is a perpetual preferred stock issued by Strategy Inc., formerly MicroStrategy, the largest corporate holder of Bitcoin in the world. It trades on NASDAQ, targets a $100 par value for price stability, and currently pays an 11.50% annual dividend in monthly installments. As of May 2026, it scaled to over $8.5 billion in market value, with around $375 million in average daily trading volume, which Strategy says makes it the largest preferred stock by market cap in the world. Here's the simplest way I can explain what STRC actually is. Imagine a high-yield savings account. Reliable monthly income, relatively stable price around $100, attractive yield. That's what STRC looks like on the surface. But here's the catch. That bank's entire reserve is held in Bitcoin. The monthly check might still come, the price might stay relatively stable, but the underlying risk is not the S&P 500. It's not dividend-paying companies. It's crypto volatility, which is a completely different animal. Who STRC actually makes sense for?
Investors who already have a view on Bitcoin, want high monthly income, genuinely understand that the underlying risk is tied to crypto and are using it as a satellite position, a small slice on top of a core portfolio, not as a foundation. Why it's not in the main framework? This framework is built on broad market exposure with known index-based risk profiles. STRC's risk is Bitcoin's risk. Those are not the same thing, and putting them in the same conversation without that distinction does investors a disservice. One more thing worth knowing, Strategy Inc. has proposed moving STRC to semi-monthly dividend payments. If passed, dividends would come twice a month instead of once, worth verifying the current status before you invest. Second, DGRO versus VIG, the honest verdict. We touched on this in Section 2, but enough people asked about it directly that it deserves its own moment. DGRO, iShares Core Dividend Growth ETF, expense ratio of 0.08%, dividend yield of 2.01%, around 420 holdings, 5-year annualized return of 10.29%. VIG, Vanguard Dividend Appreciation, expense ratio of 0.04%, dividend yield of 1.56%, 332 holdings. On paper, DGRO wins on yield. 2.01% versus 1.56% is a meaningful difference if income matters to you. But VIG wins on cost. 0.04% versus 0.08% is also a meaningful difference over decades. Here's how I'd actually think about this decision. If you're in your 50s and income is starting to become a priority, DGRO's extra 0.45% yield is worth considering. The additional cost is relatively small and the income difference is real. If cost minimization is your North Star and you're happy to wait for the bigger income payoff in your 60s, VIG wins. Both are excellent products. Both are built on the same dividend growth philosophy. Choosing between them is not a high-stakes decision. It's a preference. Neither is a mistake. Pick one and move on. Third, GPIQ. Quick take. GPIQ is Goldman Sachs's NASDAQ 100 covered call ETF. Same structural idea as JEPQ, generate heavy monthly income from tech-heavy holdings using a covered call strategy. Current yield runs approximately 9.1% to 9.4% depending on market conditions. Where it fits? Alongside JEPI or JEPQ as an income kicker for investors in their 60s or 70s who want NASDAQ exposure in their income sleeve. It's not meaningfully different from JEPQ in terms of philosophy. It's more of a Goldman Sachs versus JP Morgan preference at that point. It doesn't make the main framework because the framework prioritizes simplicity and proven long-term track records. GPIQ is a solid product, but it's a complement, not a cornerstone. Fourth, JGRO. Quick take. JGRO is JP Morgan's actively managed large-cap growth fund. It targets high-quality U.S. companies with strong earnings growth, minimal yield, somewhere between 0.15% and 0.2%, because this is a capital appreciation vehicle, not an income tool. Where it fits, it competes with SCHG and VOO in the growth phase of the framework. It's an active management bet, the idea being that JP Morgan's team can identify quality growth companies better than a passive index can. That's a legitimate philosophy. Some investors believe in it, but it comes with a higher fee than SCHG or VOO, and the historical evidence on active management consistently beating passive indexing over long time frames is not convincing. It doesn't make the main framework for that reason. Low cost, passive, index-based, that's the foundation this framework is built on. JGRO is a reasonable alternative if you believe in active management. Just go in with clear eyes about what you're paying for and why. All right, let's bring it home. 6 ETFs, 6 decades. Here's the whole thing in one place. Your 20s, SCHG, the Formula One car, pure speed, maximum growth, 0.04% cost. $100,000 became $502,169 over about 9 years. In 2022, it fell 31.8%. And if you're 24 years old, that is completely fine. You have time. The speed is the point. Your 30s, VOO, the whole city, diversified, cheap, reliable. $100,000 became $374,194, same period. Top 10 holdings make up 38% of the fund, more concentrated than it feels, but still one of the best long-term vehicles ever created. Your 40s, VTI, every corner of the American economy, 3,456 stocks, small, mid, and large cap all in one ticker, slightly lower return than VOO over this specific period, but broader diversification that tends to smooth out over very long time frames. Your 50s, VIG, quality over quantity, landlords who raise rent every year, through recessions, through pandemics, through everything, fell only 9.81% in 2022, while the S&P 500 fell 18.18%. Read that again. Your 60s, SCHD, the income machine finally kicks in, 3.22% yield. $1 million in SCHD generates $32,200 a year, about $8,050 every quarter without selling a single share, fell 3.23% in 2022, while the market fell 18.18%. Read that again. Your 70s, JEPI, maximum income, minimum drama. A 30-day SEC yields in your 9.78%. Covered call strategy fell only 3.52% in its worst calendar year of the last 2 decades. Hold it in a tax-advantaged account. The ordinary income tax treatment in a taxable account will eat into that yield more than most people expect. Now, before I let you go, I want to say something that has nothing to do with tickers or expense ratios or backtest numbers. The biggest threat to your portfolio is not a bad ETF. It's you. Not because you're a bad investor, but because you're human, and humans are not wired for this. We are wired to run from danger. We are wired to follow the crowd. We are wired to feel the pain of a loss twice as sharply as the pleasure of an equivalent gain. Every single one of those instincts, perfectly reasonable in every other area of life, will work against you in the market. Selling SCHG in March 2020 because it felt like the world was ending, moving everything to bonds in late 2022 and missing the recovery, watching your neighbor brag about his crypto portfolio and quietly wondering if you're doing it wrong. These are not stupid decisions, they're human decisions, but they are the decisions that quietly destroy wealth over time. The research on this is consistent. The average investor underperforms the average fund, not because they picked bad funds, because they switched in and out of perfectly good funds at exactly the wrong moments. It's like starting a diet on Monday, seeing no results by Wednesday, and switching to a different plan, then switching again on Friday. You never give anything long enough to actually work. The person who eats consistently and boringly for 10 years will always beat the person who chases the perfect meal plan every week. ETFs work exactly the same way. Pick the right framework for your age, contribute consistently, don't stop the snowball, and when markets get scary, because they will get scary, they always do, remember that the fear you're feeling is the price of admission. Every investor who ever built real wealth paid that price. They just didn't sell. One more thing before we wrap up, and I want to be straight with you about this. Nobody can tell you what markets will do next year. Not me, not the analysts on TV, not the guy in your group chat who got lucky on one trade and never stopped talking about it. Everything in this video is based on what the data showed over specific historical periods. The logic behind each pick holds up, but past performance is a guide, not a guarantee. Make your own decisions. If your situation is complex, large taxable positions, early retirement, unusual income, talk to a financial advisor who knows your specific numbers. For anything tax-related, please talk to a tax professional. The framework is sound. The application is personal. Drop a comment below. Which decade are you in right now, and which ETF are you holding? I read every single one, and the most common questions that come in from this video, I'm going to answer them directly in the follow-up. If this gave you something useful, share it with one person who's been putting off the ETF conversation. That's genuinely all I ask. See you in the next one.